Hello, everyone. Thank you for coming to this webinar on the overview of the private equity market in Africa. This webinar is based on the Bright Africa report 2021 by RisCura. Shortly, you will have a presentation by RisCura on the Bright Africa report 2021. But before that, I will quickly introduce the speakers. So our moderator today is Mrs. Mwambui Shege. She's the independent chairperson of the Making Finance Work for Africa Partnership. And on RisCura side, we have Hélène Goussard. She's an expert on alternative investments with almost 20 years of experience. She heads up the alternative investment team at RisCura, which is a market leader in investment solution in emerging markets, such as Africa, China, with over 2 billion in assets under management. She also oversees industry recognized research, such as Bright Africa and the RisCura South Africa Private Equity Performance Report. Prior joining RisCura, she worked as a corporate finance partner at PKF, and Hélène has a CA and she's a CFA. She also holds a master's degree in finance focused on valuation from UCT. So now I will introduce Diane Edwards, who is a colleague from RisCura. So Diane provides expert independent valuation of private companies across Africa for a range of clients, including private equity funds and institutional investors. Is involved in analyzing entity and market information to identify major valuation and risk driver, develop and interpret financial models, and determine the enterprise and equity value of an entity. He was part of RisCura's Bright Africa 2021 Private Equity in Africa report, and is also involved in business development tasks, including seeking new business opportunities for the alternative investment service team. Before joining RisCura in 2021, Diane completed his SICA articles at EY and served academic articles at the University of Cape Town in the College of Accounting Taxation departments. Now I will introduce our two panelists who will take part of the discussion. Mr. Dadier Tayoro is the CEO of Injaro Investments. Prior to co-founding Injaro Investments, Dadier had been an active investor and advisor in agriculture SMEs. He began in the hospitality industry and was later a business development manager at a leading marketing and advising company in Francophone West Africa. So he then worked as a business development professional in New York for Henry Schein, a worldwide distributor of medical and dental products. Dadier serves on the board of several companies in multiple West African countries, including Ghana, Mali, Niger, and Côte d'Ivoire. He is a graduate of the École Supérieure de Commerce d'Abidjan. He holds an MBA from the Wharton School, University of Pennsylvania. So finally, Mr. Hakim Khalifa is an executive partner at Africa Invest Funds, covering sub-Saharan Africa. Hakim has over 15 years of experience in private equity, including sourcing, negotiating, structuring, and executing private equity transactions in Northern and Southern and Sub-Saharan Africa. Hakim has also structured several exits from portfolio companies and sits on the board of many portfolio companies. He was a senior analyst at the auditing firm Mazars in Paris, France. And Hakim is a graduate of the engineering school of École Nationale Supérieure des Mines de Paris, France, and is a board member of the African Venture Capital Association. So this is our very, very impressive panel. Now I'll give the hand to Hélène and Diane for the presentation on the Bright Africa report.
Thank you very much for that, Elaine. So yes, as Elaine mentioned earlier, we are going to be presenting on our 2021 Bright Africa report. The full report is on our website at riscura.com. And today's webinar just aims to highlight the key findings and give you an overview of the report, which aims to highlight the state of the private equity market in Africa, including South Africa, as well as the trends in prices paid for the equity assets over time. Thanks, Elaine. So just to give you some context around RisCura. So RisCura is a purpose-driven investment firm, offers investors unique insights, advice, and investments on their journeys in achieving exceptional performance while still meeting the broader investment goals. $250 billion under advice, 12 offices around the world, 21 years of client experience, and over 150 staff, and we multiple markets served, including 26 frontier markets. Okay, so let's have a look at part of looking at the private equity landscape. We look at the investment activity, and basically over the last 10 years, we can see more recently that investment activity across Africa showed strong growth between 2016 and 2019. The total value of PE fundraising in 2019 reached $3.88 billion USD, which was the second highest reached since 2010. Fundraising highs between 2015 and 2019 was as a result of a large number or a handful of funds having their final closes. For example, in 2015, the spike was largely driven by Development Partners International, DPI, which announced their close of almost $750 million USD, and Helios of $1.1 billion USD. This also then speaks to the lumpy nature of fundraising and contributes to the sort of the contraction and the rises that we see in the fundraising graph over time, is that when big funds often have the large closes in certain years. However, in recent periods, 2020 and 2021, we saw a remarkable contraction in fundraising. We observed this to be largely driven by the risk-off environment, which then persisted and resulted in a low level of fundraising. The decrease illustrates just how much the pandemic caused uncertainty, economic distress, and the lingering effects thereof. So this, combined with downgrades, currency devaluation, and revised investor sentiment in Africa, all contributed to the decline in fundraising in the more recent periods. However, just recently, towards the end of last year, the African Development Partners, the ADP 3 fund closed almost $900 million USD, and this was towards African-led innovation companies. It was interesting to note that the co-founder mentioned that one of the reasons for sort of the fundraising and investment focus was Africa remained an exciting investment destination with positive demographics, a rise in the adoption of technology, and consumer and business spending. It was interesting to note also that the focus would be on innovation-driven companies with a key focus on digital transformation with an integration of impact and ESG. And this was also in line with some of the other trends that we observed. For example, of the funds raised in 2020, about $500 million USD or 38% was allocated towards impact fund managers. And this we note as a welcomed increase from previously held proportions of around 15% in 2017 and 6% in 2018. Looking at the line, we can see that PitchBook's US annual PE data breakdown shows similar trends in fundraising within the US markets, also following all-time highs of about $331 billion USD in 2019, up 59% from the prior year. The PE fundraising also contracted quite significantly over the next few years. In terms of the region focus, we can see the trend of Pan-African fundraising continued towards 2021, with fund managers predominantly Pan-African focus, as opposed to having a region-specific fund mandate. Which sort of allows them some more diversification. The graph that we are viewing now, there you can see it within the green bar charts as well. That's the Pan-African, increasing Pan-African focus. And if we go to the next slide and we have a look at the sector focus, historically the sector focus was predominantly dominated by infrastructure and generalist. However, we see a more generalist focus now. We can see that a trend previously observed in the breakdown of fundraising into investment themes was the high proportion raised for infrastructure. The combination of infrastructure and energy represented almost half of the fundraising that was raised between 2018 and 2019. Of the 3.8 billion that was raised in 2019, 1.6 billion USD or 42% was focused explicitly on the infrastructure and energy sectors. This represented an increase of about 18% from the previous year. However, this allocation dwindled to around only 156 million in 2021. However, on the South African side, in February this year, there was draft amendments to our Regulation 28, which sets the capital limits or the prudential capital limits for our pension funds, which specifically address investments into infrastructure, and the amendments have introduced a more effective maximum limits for asset allocation within the sector, which may see more funds redirected or pivoted towards infrastructure to increase that allocation going forth. The data for 2020 for the 6 months and the 6 months 2021 shows us that the regional split and investment themes are more generalist, that the funds prefer a more generalist approach as opposed to a more specific and so with a more broader regional mandate. One of the reasons we think is that Africa's economies remain largely informal and fragmented. According to the IMF, the informal sector makes up from 20 to 25% of GDP within Mauritius, SA, and Namibia, and up to 50 to 65% within Benin, Tanzania, Nigeria. And this limitation necessitates a wider mandate to ensure that sufficient opportunities with desirable risk and return profile can be identified and evaluated. Looking at the next slide that focuses more on the SAFCA lens, more Southern African. So we can actually see the dotted line shows the total fundraising, and the purple lines specifically towards the Southern Africa. And that tells us that Southern Africa has not been subjected to the same extreme changes in fundraising as with the rest of Africa. And this really just illustrates the structural differences between the two markets, meaning Southern Africa and the broader African, with the decline, despite the same COVID headwinds, the decline and the impact not as great in the latest periods. So that's a broad look at the fundraising trends we've seen over the past years. And then now if we look at dry powder on the next slide. So dry powder in private equity terms refers to the committed but unallocated capital a firm or fund has on hand. And we've estimated the dry powder over the last 10 years by looking at fundraising data, as well as looking at the average deployment rates that we have observed at RisCura. Of that exercise, we found that most funds would have fully deployed their funds within 8 years, and then we worked back to look at the balances for each year. And then looking at what we've observed, we can see that dry powder levels average around 8.51 billion USD until 2018. It then reached a high of about 9.56 billion in 2019, which was only previously achieved at around 2016. So that was the recent highs. And then we see in 2019, the rebound sort of correlates with the spike we saw in the broader Africa fundraising. The levels declined to around 6.5 billion by June 2022. And this is quite intuitive in that the decline relates to funds continuing to draw on committed capital to invest in new business and support existing investments through the pandemic without the corresponding flows of commitments from LPs through fundraising. It's good to note that this reduction in dry powder should contribute quite considerably to the stabilizing of the private equity pricing going forward, which we will look at in a bit in the next few slides. If we go into the next slide, what we can chat to now is the investment activity over time. So if we look at this graph, which is it shows us that investment total private equity transaction activity steadily increased by 20% between June 18 and June 19, tapered slightly to around 9% between June 19 and June 20, which is sort of like defied the collapse in fundraising. However, transaction activity rebounded strongly by June 21, resulting in a 19% increase from June 20 to June 21. A key observation, however, is that while the quantum of transactions occurring is increasing, the value of transactions is not. In our database, we saw the average transaction value in our database between 2016 and 2019 was around 40.44 million USD, whereas in the last 2 years, 2020 and 2021, we saw that to shrink around 11.1 million US dollars. So if we look at the geographic split, over the past 3 periods, so South Africa represented quite a relatively constant share of the investment activity, or around 25%. Despite the limited growth prospects and increased risk profile, it still showed quite strong growth, growing 13% between the last period, 2020 and 2021. So then, as a continuation of the historical trend and an uptick of about 104% in the current period, the latest 2 periods, Egypt grew between 2019 and 2021, about 104% in investment activity. This also speaks to Egypt's ranking on RMB's Where to Invest in Africa. So that's an investment bank in South Africa. They published a report, and they've ranked RMB as the #1 investment destination in Africa, citing its large, diversified economy, improved business environment stemming from recent investment in legal reforms, and also that which then resulted in improved investment sentiment. Another notable country is Morocco, that despite being ranked second on that same ranking, it has not attracted significantly more investments to the region, which is the region of Maghreb. This we believe is partially due to the reluctance to invest in tourism-sensitive economies, especially in recent periods. Looking at the East African portion, so East Africa has remained relatively stable over the past 3 years, at around 20% of investment activity. Within that, Kenya accounts for about 64%, which is the largest proportion of the East African investment allocations, representing an increase that was in the latest period of 64%, representing an increase from 52% within the prior period. The country dominates the investment landscape in its region, following its due to its diversified economy, pro-business government policies, and relatively low dependence on commodities. Looking at Nigeria, so deal activity in Nigeria followed the continent average and increased around 18% for the latest period that we had under review, compared to prior jumps of 50% and 13% in 2019 and 2020. Nigeria currently represents the most significant portion of Africa's investment activity, with information technology, IT investments dominating the sector allocations. Similarly, Africa's largest economy, Nigeria, accounted for 70% of transaction activity in 2021. And the reason for the large attention towards Nigeria is that we've understood it, is that the improvement is as a result of large consumer demand, government incentives, and overall improved foreign exchange liquidity. So the Nigerian government has also made considerable efforts to support small and medium enterprises through monetary reform, which is fundamental to Nigeria's development, and may also aid them to expand into other sectors, IT, etc., and shift them away from being a commodity-reliant economy. So that's kind of an overview in terms of where the activity is occurring. But if we go into the next slide, we can just we can touch on what sectors are attracting the fundraising. So if we look at the sector slide, recently the COVID-19 pandemic has really exposed the importance and likely greater focus on specific key areas such as healthcare, pharmaceuticals, education, IT, especially with investors being attracted to tech-enabled businesses that can sustain growth through the current period, as well as being future-proof. So then we look at investment activity in consumer discretionary remains stable over the years. And within this sector, investors' interest has moved towards internet and direct marketing, retail, education, and communication services and publishing. And this possibly shows a shift away from targeting a broader market with lower income to a smaller market with higher income in the space. Internet and direct marketing retail companies, which is also classified within the subsector of consumer discretionary, discretionary enjoyed a 63% growth. And given the events following the global pandemic, the shift to online retail has really been accelerated, and e-commerce in many parts of the world will likely be revolutionizing and will present substantial opportunities going forward. Investment in the IT sector experienced significant growth of 49% from June 20 to June 21, with this proportion of total investment increasing from 24% to 30%. Investment in the sector mostly consists of internet software and services, application software, data processing, and outsourced service companies. And a large majority of these are towards venture capital application software, with Egypt, Nigeria, and South Africa and Kenya, if we speak to the regions, attracting the highest level of investment in the sector. Furthermore, following the more subdued period in the prior assessment period, investments in healthcare increased by 40% during our last period, with venture capital investments into technology healthcare subsector attracting the most investments, with Egypt and South Africa being the biggest gainers. And we've noted this to be primarily driven by the increased focus on the sector and the opportunities that it presents within Africa and at the time of the period under review. Two other traditionally large sectors for investment, namely the financials and industrials, have attracted similar levels of investment activity compared to prior, of around 9% and 13% respectively. And then weighing it at around 10% of investment activity, we see the communication services sector increase 43% over the last period. This is the largest subsector of the category media and services, which includes companies engaging in content and information creation for distribution through different platforms. And this really just grew largely on the back of the pandemic, which catalyzed the shift towards digital media consumption. And then if we look at the next slide, so we've touched on the fundraising, we've touched on where the amount of money that is sitting as dry powder, where that money is going. But ultimately in private equity, a big concern has been, and it's been cited in multiple surveys, is around the exits. So exit data published to date does not really specify the actual value of it, but we are able to see the number of exits that are occurring. And according to AFCA, private equity had an average holding period of around 6.4 years between 2010 and 2021. Trade buyers remained the most popular African private equity exit route, and they represent existing businesses wishing to synergize the PE company with their current operations. And then this is followed by exiting through financial buyers, with the third most popular exit being management buyouts. However, IPOs represent still the least popular exit route on the continent, and this is mainly because of the illiquidity that characterizes the stock exchange, as well as regulations and hurdles that may slow down that process. Exit activity reached highs within 2015 and within 2015. I think the next slide. If we look at the number of exits that are occurring, I think you can see in 2015 we had record highs of around 56 exits on the continent, and then subsequently the volume of exits reported dropped to an average of 47 per year between 2016 and 2019. And more recently, 2020 resulted in 33 exits. And then during the last period, the 6 months, June 21, we had observed 16 exits over the period. So AFCA, and we've also observed that the lower exit activity is mainly due to the decrease in exits within South Africa, given the backdrop of the heightened macroeconomic uncertainty in the country. In 2020, the number of exits reported on the continent decreased significantly to 33. And this reflects the economic implications of the COVID pandemic that left, and the fact that GPs decided to, in the instance of the uncertainty that the world was facing, to prioritize portfolio management and protect the investments and exit when the time was right, and not during the uncertainty. So we also noted that most of the exits occur within North Africa and Southern Africa, Since 2010, financials have consistently been one of the main sectors of exit investments, and representing almost on average over a quarter of all African exit activity, with industrials following closely behind on that stage. Now that we've looked at the landscape that we find ourselves in with the private equity ecosystem, we can now have a look at what is the pricing and how all of these ties in terms of what prices are being paid for the investments. And now I'll hand over to my colleague, Diane, who will take us forward. Thank you.
Thank you very much, Diane. Alan, if we can go to the next slide. Thank you very much. We can very clearly see the impact of the COVID-19 event when we look at the widening of credit spreads between the period of March 2020 and at its peak at May 2020, where after those levels slowly but surely returned to a much more normalized position. There are some exceptions to the rule, such as Ethiopia, which is facing a heightened risk environment. And there's some exceptions to the other half, which is, for instance, Morocco and South Africa, which has had a slow recovery in risk rates over the period. If we then go on to the next slide, we're looking at private equity pricing in Africa. This is one of the more interesting slides and one of the more interesting bits of information that always comes out of the Bright Africa report, which is the median EV/EBITDA multiples of the listed sector versus the private sector. As you can see, that there used to be a difference between the listed and the unlisted sector, with the unlisted sector have slightly lower EV/EBITDA multiples, which is traditionally thought to be the liquidity premium that you would pay for a listed share. And as you can see, that roughly from 2010 all the way to 2015, 2016, the African markets followed that trend. However, between June 2017 and then June 2020, you would have seen that there was little to no difference between listed market prices and unlisted market prices. It is important to remember that the level of liquidity which exists in listed markets in Africa is more limited than when you're, for instance, looking at a similar graph in the developed world. However, it was indicative of the fact that there was significant dry powder that had built up in the system, something which Diane had highlighted in his graph showing the different levels of dry powder. So if you correlate that graph between 2016 and 2020 is the high point for dry powder on the continent, with now that dry powder significantly decreasing between 22 and 21. We can also see the pricing of transactions then also going down from 2019 to 2020 to June 2021. And there is now again that same relationship that you would expect between listed and unlisted multiples within a market. If we go to the next slide, we'll see that this is South Africa's private equity prices. In some ways, South Africa has been the inverse position than the rest of Africa. As a negative market sentiment, it really has kept the pricing of private equity assets in check, with they remaining very firmly in a band between 5x and 6x, and even in the last couple of years falling close to 4x. There's been a recovery, as an expected recovery, in the listed markets between June 2020 and June 2021, which is reflected in the unlisted pricing as well. However, it still remains at quite a low and quite an attractive level, with a significant differential between the listed and the unlisted market. If we then look at the next slide. So when we talk about the availability of debt is often driven the private equity market, especially in the developed world. So if we first look at the two lines that we can see on those graphs, those is the US's private equity and debt levels, which drives pricing. And as you can see, in essence, what happens is, depending on how much debt you can raise on a transaction, which is the orange line, you will add a 4x or 3x onto the price of that, 3 turns of equity value, and you will price your asset accordingly. And this relationship has always been extremely strong. We saw in the year 2020, in June 2020, that actually broke slightly, in that the levels of debt that was raised was not as aggressive, but the prices in assets still went up and contracted back down for June 2020. And this may be the result of impact of a differential and impacts in quantitative easing. However, if we compare that, which is maybe the more interesting part for us here in Africa, is to what happens with African private transactions, you'll see that it's always been a very, very small component of debt. And on the one hand, this has been a positive thing because it has de-risked transactions on the continent. So if you don't have large levels of debt, it does mean that your position in the equity is not leveraged, and that de-risks it. However, what it also means is your position in the equity is not leveraged. In other words, you don't get leveraged returns on the equity. So as we can see, as in the June 2020 year, we've had a significant recovery in the levels of debt within the African market. It is not clear whether that is part of a deepening in the debt markets and a structural change in the debt markets, which we've been experiencing in Africa, because there definitely has been, private equity funds have been looking at other ways to access debt, and there definitely has also been a deepening in terms of the private credit market offering to companies. And it would be, we hope to see this trend in the future and see how it plays out in the next couple of years. If we then go to the next slide, these are really about transaction multiples and what we pay for different transactions in different bands. Now, if we look at the South Africa, and the top graph is about what proportion of your transactions falls in which particular bucket. So if you look at the top on the left-hand side, you see South Africa, where the overwhelming majority of transactions falls in the 3x to 7x bucket. And if we think back to the graph we were looking at previously, we know that to be the case. The average median multiple has been between 4 and 6, largely for the last 10 to 15 years. So with a very small amount of transactions having multiples at more than 7, and in fact, as time has gone on, that amount has become less and less and less, as South Africa has faced significant headwinds, and the willingness to pay a higher price for assets has not necessarily been there. However, if we contrast that to the Africa situation, which is on the top right-hand corner, you'll see that in July 2012 and to June 2015, and the first period for our comparison, that there was more deals done in the 3.5 to 7 range, but which is very quickly, that has decreased all the way, while the darker purple line, which is the above 7x's, have increased dramatically. Also in support of what we know for pricing levels and assets is that the majority of assets in Africa are trading at 7x and above. If we then look at the bottom part of the graph, that really speaks to what multiples being paid for companies in different size ranges. So at the bottom on the left-hand side, we have South Africa again, where we will see that it doesn't necessarily reflect the traditional pattern which we would expect. So if we look more towards the bottom on the right-hand side, Africa ex-SA, that's much more traditional, where you have the smaller your transaction is, the smaller the multiple, and as larger it becomes up to a large transaction, which normally commands a large multiple. However, as I say, in South Africa, that has not necessarily been the case, and this may well also speak to some of the structural weakness in growth and broad-based economic return, which has made large transactions, which in essence need South Africa Inc. to do well, for those companies to do well, being less in demand versus more niche investments where growth could be obtained. If we then go on to the next slide. These are really for graphs for South Africa to show us what the size, sector, and volume trends have been. The first thing to observe is that the scale on the top and on the top graph ends at 90, while at the bottom graph it ends at 250, which just speaks to the expansion of activity between the two periods, being between 2010 to 2015 at the top and 2016 and 2021 at the bottom. So what is quite interesting is you do see at the bottom on the total right-hand side, an outlier by itself is information technology, which has the number of transactions has increased dramatically, and also the multiple has increased, which has not been the norm for South Africa over the period. So if we, for instance, look at consumer discretionary, which is the large light green bubble, it's gone from 6.13 down to 4.51 in the bottom graph. Again, most probably reflecting the softening of the South African consumer market and a lack of belief in the long-term growth story of SA. Similarly, we would see, for instance, in the materials transactions, you'd see that they're 5.23 between 2010 and 2015, but 4.5 in the South Africa side at the bottom between 2016 and 2021. And in general, that's what this trend has shown us. There's been an increase in number of transactions, but there's a softening in the multiples over the same period of time. If we then go to the next graph, this is the same graph for Africa ex SA, where we look at the size, the sector, and the volume trends. And so here we can see the inverse. If we look at the top, again, there is the stretching of the scale between the first and the bottom part, where the first graph goes up to 160, but because the number of transactions have grown so exponentially in the second half, you'll see that the graph at the bottom goes to 500. And then similarly, you'll see that there's information technology was already a relatively popular and a highly priced item in the first graph at 6.4, the dark purple graph, but when you move down to the bottom, it is the outlier on the right, and is also relatively expensive at 8.53. The other thing that you can observe is you can see that all of the multiples really that you're looking at have increased the multiple over time, as well as the number of transactions. The big shift has been between financials and information technology in terms of the type of transaction which is targeted, with financials becoming less popular and information technology becoming significantly more so. And then again, as I say, it's just the general trend of a higher price being paid for assets over time. Elaine, go to the next. So thank you very much for the chance to present our findings.
Thank you very much, Ellen and Diane, for this very insightful presentation. So we will now move to our panel discussion, and we invite Mr. Dadje Tayoro and Hakim Khalifa to take part of the discussion.
Highlighted in the report, the market is moving into smaller transactions. And this is also driven by the fact that, there is quite a high interest into venture capital. Ourselves, we have raised a fund investing in VC into innovation in 2019. And it's a very, very active market. I mean, there is a lot of innovation, entrepreneurship happening on the continent. We've done a market survey, and we've decided to position a fund in late stage VC, investing into companies that are able to scale, actually. And we've built very strong portfolio over the last 2-3 years during the pandemic. And this is, I think, a trend that we see and we continue to see on the continent. In terms of pricing, maybe one comment on that. Two things that I wanted to mention. First is that it depends on the market again. From our own experience, there are certain markets like Egypt where its market is very competitive and valuations remain on the high side, while other markets like Francophone West Africa, the market is also dynamic, but valuation remain reasonable. So, I think that the pricing effect is also depends quite heavily on the region and on the location. Also, I've seen that in terms of pricing, there is an issue of correlation between listed and unlisted markets, especially in sub-Saharan South Africa. So South Africa remains actually quite consistent, but not in the rest of Africa. This is, in my opinion, also linked to the fact that even listed markets are not liquid in many capital markets in Africa. So, sometimes the price of the listed assets doesn't really reflect the reality or the value of the asset, because there is not enough liquidity to acquire a meaningful stake, through the capital market. One maybe last comment would be that good quality assets are very competitive, and also, assets that have a certain scale are competitive, and investors are ready to pay for it. And this is also driven by the fact that, I mean, the impact, this is maybe not obvious, but actually, I mean, what we've seen is that companies that have the right scale are actually easier to I mean, these companies, it's easier to create value in this type of companies because you have the scale to bring, I mean, consultants to, I mean, invest in technology, etc. And I can give many examples where, because we have a company of scale, we've been able to invest in AI, I mean, bring new technology to the company and make it grow even faster, actually, also through M&A transactions and through acquisitions, actually. This is more difficult, I would say, in the SME space. So so actually that's why we believe that there is more competition and prices are higher on the bigger assets as well. So these are in a few words some of the comments that I wanted to make on the report, but I'm happy to answer any questions, of course, from the attendees.
Sure, absolutely. Thank you so much, Hakeem. And I actually also have a few follow-up questions, but I want to hear from Didier first. And also, thank you for also articulating where the money is going and where you see the opportunity. It's interesting to hear that you are willing to take a lot more risk than previously, and particularly during this very difficult period that has just been with us. Didier, I would like to invite you to please give us your immediate reaction to the report and tell us how you see the future of the PE market in Africa from where you stand. Oh, you're on mute. We can't hear you.
Can you hear me now?
Yes.
All right.
Perfect.
Okay, great. Thank you very much, everyone, for being on this webinar. I'm going to be more the voice of, you know, the small cap type of transactions, because, you know, the report is great, but like Kim just said, you know, we have a very diversified Africa, you know, with different markets. And within the markets, we have different types of assets that reside in those markets. So here, I'll you know, I'll hold the voice of you know, the small you know, companies and investments. What we're seeing in general on that side is that beside the huge transactions, we're not seeing much happening on the small transaction side, specifically after the pandemic, and you know, we saw the growth of, you know, investment coming in Africa despite the difficulties, but still this has not translated into getting to the smaller you know, actors of the economy, which is problem for in Africa in general, where you see that the demographic is growing, the needs are growing as well, but the resources to get to those needs are not getting there. So for me, I think that in general, the prospects for growth for private equity in Africa is strong, given the fact that the fundamentals of creating assets are there. We also note that there are a number of players. The platform of private equity growth in Africa is coming up in different regions outside of Southern Africa, Eastern Africa, and some part of North Africa. We're seeing that, you know, there are existing platforms, and it's a good thing that we are also noticing in West Africa. Obviously, we always have Nigeria, who is going to be playing in its own league, but in other part of West Africa, you know, initiatives are also coming up with the West African Monetary Union, you know, trying to set up a framework to allow for the growth of private equity in this region. There's been a seminar recently on April 1st in Dakar to shape that environment for private equity to be able to grow in West Africa. So to me, one of the points that I saw, I think in the report is about the different sectors that I mentioned. And I haven't seen particularly one thing that is, I'll say, critical, fundamental for the continent, for growing demographic, which is agriculture. And this is very much reflective of, I'll say, the more mature markets, like Southern Africa, some part of North Africa, but Eastern Africa, this is critical, where I'll say we see the investment going, and every time you go to every reflection that is made on the continent, you'll see all this, the usual suspect, which is technology, but areas where we don't see enough money going, like healthcare. Well, healthcare was mentioned, but education, not much in education, agriculture that represents what 60, sometimes 65% of the active population in our countries, where we are not seeing much investment going. So to me, I think that from the perspective of this report, which was talking about the continent in general, did not get into details, but I think that these are some of the things, some of the aspects in which we could get deeper with the upcoming discussion and question. Thank you very much.
Sure. Thank you, Didier. So, Didier, I have a follow-up question for you, because the report did talk about, for example, political instability, the macroeconomic environment in many countries, a big factor for attracting investment. And you spoke about the changes that are coming on in the Wayamo region. Could you tell us a little bit more in detail what exactly the monetary union is looking at to make the region more attractive for PE investment? If there's anything we could learn, for example, in East Africa to make our markets more attractive.
Yeah, thank you very much. What the monetary union is trying to do is, it's like they're waking up to alternative investments. You see, one thing that is critical in everything we do is, most of the investments outside again from Southern Africa, where they have a more structured market, they have institutional investors in the form of pension funds, insurance companies that are big and understand that they need to put some of their assets into this class of assets. Here in West Africa, for instance, we are just waking up or learning about what is private equity. So in the West African Monetary Union, for instance, there's been a fight for over a decade about who was going to regulate the markets. Fortunately, a couple of years ago, they decided to choose, the regulator of the public markets, to also regulate private equity assets. And we are in the process of negotiating, discussing, the framework between, are we going to have a private equity act versus a directive for all the countries? And these are some of the aspects we are negotiating. We also have the tax incentive issue, because if you want to build private equity markets, you need to entice people to get onto the market, and tax is one of the main bites to get people into private equity. So these are some of the key issues that we are currently negotiating with the institution of the West African Monetary Union.
Yeah, great. Really interesting to hear. And I'd just like members of the audience to know that at Making Finance for Africa, we actually do work in long-term capital markets development, which is really interesting and pertinent for this discussion. And I invite you to visit our website, join our sessions, and if you can, some of our working groups that are working in this space. So one question for Elaine. As I was reading your report, one of the things I wondered is the question of exits and why people really fear doing investing in, especially outside of a market that's as liquid as South Africa and outside of Egypt, for example, is how do we exit? And you talked about what the exits are looking like, but what can be done to improve the opportunity for exits for investors?
So, I mean, just a couple of things on that. The first is you would have seen that there was sort of a switch in terms of exits. For there was a brief period where there was a big flourishing of a PE to PE exits, you know, where what you call a financial buyer was buying when another person was exiting, which I think in general is an exciting thing for us. And I think it falls in line with international trends and understanding of capital markets, you know, which, you know, when you're looking for sustainability in a trend, that's one of the things which, if you can see that it falls in line with understanding of international capital markets, it helps. But what it is around is a listed market. You know, in Africa, we're trying to develop a listed market, and it is a bit of swimming against the stream slightly. Because we would have seen in the developed markets that actually they are all having troubles themselves. There was a flourishing period for listed markets. And then even though the market valuation of the listed markets is going up, the amount of tickers on those markets are not. So the amount of companies making themselves available for investment on a listed market is in fact shrinking. And that's partially part of why the reason why alternative assets is so very popular at the moment in the rest of the world is, you know, for whatever reason that is true, that, you know, that's an ongoing last 10, 15-year trend, which is continuing. And so what's happening is people are finding other ways to invest money into companies because you can't get access necessarily there. And so from that point of view, you know, we're very much on trend in terms of alternatives. But what's interesting about Africa is we almost missed the blossoming period, right? When everybody got themselves listed and now they were historically listed. So what we have actually is the private market is burgeoning, but it's almost got nowhere to go because, you know, there's illiquidity on the markets. Markets aren't that well developed. And so what's happening is people are starting to sell assets from one private holder to another private holder. But which also makes sense in a way because private equity's model always is I buy, I build, you know, I make better, and then in theory I sell at the end of that cycle. But the thing is, Africa is not on a three-year sprint for growth. You know, it is on a long-term growth path at the moment. You know, we can sustainably show GDP growth north of 4%. And it's not going to be for the next 3 years, it's going to be for the next 15 years. And so the fact of the matter is that you can hand off a private equity asset from one private equity owner onto another fund, which has a different skill set and a different aim on it. And they can still sustain a private equity-like returns for that fund as well. And so from that point of view, you know, that is a trend which I see growing going forward. And I expect that as the depth in the market also changes, the type of person who holds a fund, like you've got smaller funds which hold smaller assets which grow to a certain size, and that gets sold to bigger funds which have a different interest and a different, you know, a different way of looking at assets. So I think that that's definitely going to be a growing trend. The second part of exits is that exits are often to trade buyers, which is another way in which it sort of feeds that whole capital market system. You know, trade buyers are in essence people who are going through an exercise of consolidating and creating synergies out of their purchases. So what happens is in essence, they'll put the smaller stuff together to make a bigger whole, which again is, you know, Kim mentioned this, a large, well-governed company with a good growth prospects is the diamond in some ways. And so really that's what PE is doing at the moment, is creating those things and going forward and giving a supply of companies which can be invested into. You know, so both of those things I think is quite positive. I think that the exits have been difficult, but I think the average holding period has moved over the pandemic period from 8 years to 6.3, which is much more attractive and much more in line with what we expect internationally. And I think what is quite important and which I think will be exciting to see in the next couple of years is if we look at PE's its performance. If you look at what's been exited versus what has not been exited, what has been exited is done extremely well and is in line with risk-adjusted expectations. However, that which has not been exited has not done well. But it's difficult to understand exactly how well and not well until it gets exited. because valuations in the continent tend to be depressed for many reasons. And so as those things start to exit, for us to get a clearer picture of the last couple of years, where fair enough, private equity might not have done as well as it's done in previous cycles, and it's most probably going to do in the next cycle going forward. But for us to get a realistic picture of what that means looking forward. Sorry, that was a very long answer to your question.
No, thank you.
If I may add something, sorry.
Sure, go ahead.
Yeah, I think it's an important topic, and I first would like to confirm what Helene just said in terms of, asset going from a fund to another. This is quite a trend in the developed markets, and we have a small activity in Europe. Clearly, the assets are basically go through first LBO to second LBO to third LBO, etc. So this is how basically companies or PE funds exit to other PE funds, depending on the size of the asset and the region, etc. Now,
well, we can't hear you very well. I don't know whether it's me or it's on your side, Hakim.
I think we lost Hakim.
Okay, no problem. What I'd like to do is to invite questions from the audience, and I can see that some of them have already been answered. So thanks to the panelists who have done that. We have in our audience a gentleman by the name of Michael Fuchs, who is a financial markets expert, and he's also working with the Making Finance team. Michael, may I invite you to ask a question on this session?
Thank you very much. Can you hear me?
Very well, thank you.
Good. I posted a question, not knowing whether there'd be time to actually ask a question. When I'm listening to our experts and to those who wrote this report, I was wondering whether, and I appreciate also the remarks by one of the gentlemen here, whose name I don't know, I'm afraid, on the importance of dealing with SME finance, and that in fact the report showed that most of this funding from private equity does not go to the SME sector. So my question is whether there has been you've given any thought to alternative vehicles that might be useful for promoting what is the kind of the essential sector in Africa, which is SMEs, perhaps with subordinated debt vehicles, because they solve some problems. They don't take the equity from the owner. They don't pose an exit problem. And they're actually more attractive for institutional investors who don't know private equity in Africa all that well. And I think that's the case for example, pension funds in even the bigger markets like Nigeria. So I wonder whether you've given any thought to that, or whether that's kind of off the map of this discussion which you're having right now about simply private equity.
The first thing I need to say maybe is that when we put private equity information together, it actually is a bit of private markets really. There's guys infrastructure in there, which is within the private equity funds. And Diane put up some of the stats. About a third up to half of all the capital raised under private equity is actually more infrastructure, depending on how you view the difference between PE and infrastructure. And there's a bit of private debt in there, and I know it's not exactly the same thing, and I think, Michael, that's worth discussing. Is there's different types of debt investment vehicles if we look along the the possibilities. On the high end of the scale, which is normally very much within this data, and we see that coming in, is the guys who do a mezzanine type lending to medium-sized firms, often with equity kickers or warrants or whatever, which gives it a very private equity-like feel and return. I take your point that is also not SME lending, right? So we all know who they're lending to. It's reasonably big companies, and they often do so in conjunction with PE firms. So they're helping to sort of fill that gap, which we spoke about in terms of, if you look at the mix between debt and equity, which funds businesses in Africa at the moment, you know, it's historically been very low. And that really has given a gap to people to try and fund these businesses outside of deposit-taking institutions, banking institutions, and there's a gap for that in the market. But outside of that, when you look at the debt vehicles and you look at who is funding it, you know, your next option, I can almost say you have an empty desert, and then you right at the bottom, you actually have microfinanciers, which they are financing individuals, but often they're also financing businesses, you know, because that's the only financing that's available to a lot of people trying to start a business, or just need, you know, some way to basically, they need insurance money to bridge a gap in their business plan, which is obviously extremely unaffordable and not necessarily the type of funding that you want to fund a business on. But then, so then there's the area between the two, right? And we know that the banks do play there a bit, but not as much as one would hope, because the banks have easier options available to them in terms of deploying capital. So in terms of what we've been seeing in that particular space is we have seen a lot of people playing in, well, no, not a lot of people, that's not fair. There's been quite a few funds which have tried out the equity route for that SME space. And that's been something where some thought needed to be given to what model works in that space. So, you know, if you take the private equity model and you just directly try and apply it there, you know, that has certain limitations. And so, you know, there's definitely still some thinking going into how do you venture into that space. And there's a difference between the SME space, where you are either investing or lending money to small and medium enterprises who are organically growing. And then there's a line between that and VC, where your venture capital play has normally got to do with, you know, putting money into something that could conceivably have exponential growth, which makes that, you know, the economics on a portfolio-wide basis makes sense. So it's also not that. So when we talk about SME funding, that's sort of the space in between that. And to answer your question, I think the equity side is difficult. I think the debt side looks more attractive. I think people are slowly but surely becoming more aware of that. But I think the amount of vehicles which are institutional ready and can offer that product is very limited at this point in time. And so, you know, there's a bit of a chicken and an egg situation, is you need enough offering to be of interest to investors, but you need investors to be interested to make the offering. And so at the moment, I'd say we're in that stage of it. You know, people are starting to put some products together and trying to find the one or two people who would be interested in something which you can't necessarily show a significant long-term track record at the moment for that particular niche type of thing which you're trying to do. I hope that answers your question, Michael.
Thank you. Thank you, Elaine. So on the question of financing SMEs, I actually would like to hear, this is the last question, if Hakeem and Dadier have anything to say about that.
I think
I was hoping I can start, but my internet will allow it. Actually, sorry for the issue. So basically, we have an experience actually to financing SMEs that we have launched 4 years back, actually, that have been quite active on the continent, investing into SMEs, the SMEs, with ticket size of around $5 million. I think, as Eileen mentioned earlier, the difficulty was in investors interested in that space. It's a company, it's not a fund, actually. So finding refinancing at reasonable terms to allow the company to provide funding at reasonable terms also to SMEs has proven to be difficult, and but we will still continue with this space. And then also the issue of currency, because I mean this is lending in hard currency to SMEs, and unless the company has revenues in USD or in euro, it's a challenge that can be important. So we try to focus on exporting businesses, on business that earns a part of the revenues in hard currency, but it limits actually the market for us, in fact. So these are the two challenges that we've seen in the debt space, but we believe that it's a space that will grow, certainly grow, and it's not enough served today, I mean, in the continent.
Sure, absolutely. Didier, any closing comments you would like to make?
Very quickly, I think that Hakeem was going to touch on this. He was talking about flipping assets from one fund to another. Just to give an example, we tried to exit one of our funds through a secondary sale, and our investor told us, don't even think about it, because these type of exit routes are not mature in our environment. About financing SMEs, I think that fund managers and funds and investors have to be creative. We talked about the cost of capital or investments. Yeah. Well, if you look at it in terms of monetary value, there are differences. There are areas where it's cheap, other places where it's expensive. But in general, in the SME sector, equity is always expensive because of entrepreneurs' reluctance to share the control of their assets. So fund managers and funds alike have to be creative. And what we try to do in our case is to put in place liquidating instruments to ensure that by the end of the investment period, we exit properly in a proper manner, the investment. But that's what it is. Thank you.
Fantastic. Eileen, I'd like to invite you to make your lasting remarks based on all the comments and the discussions that we've had today.
Sure, Vicky. I think the one I would say is that the market is continuing to grow. The continent macroeconomically is doing well. The amount of investments available to invest in is growing. The amount of capital that's aimed at it is growing. There's been, the prices were elevated for a while, which made it difficult possibly to make, the best possible returns on it. But at the moment, those pricings are very much normalized. And so forward looking, I think at the moment is a very, very important time for African private equity. I think the ability to start showing some of the performance, which, it is warranted for the risk which is there. I think the fact that there's so much development and there's so much going into the market, I think this is a moment where we can possibly see some really good returns coming out of it in the next couple of years.
Oh, thank you. So I want to thank everyone and thank you to the audience as well for staying with us throughout this very interesting session. I mean, the discussion was really rich and unfortunately we've reached the end of the discussion, but let's continue the discussion online through our LinkedIn audience as well as with the various profiles and together as Making Finance Work for Africa. What I'd like to say is that I'm very inspired because COVID was really hard for many of us, and even just hearing what Hakeem said, that it's really hard to build new relationships when you're not having face-to-face meetings. And for me, I think this is one of the few times that I've participated in a discussion on the PE market. So it's great to see this opportunities arising. Thank you for highlighting where the money is going, for highlighting about the fundraising and also about the pricing and what that has meant. And I think we've all had very, very clearly that there is a huge market still and a huge gap remaining for the missing middle, which we all need to put our heads together to address. So thank you very much, everyone. Please let's stay in touch and have a wonderful Easter break. Bye-bye for now.
Thank you very much, everyone. Enjoy your Easter break.
Yeah, thank you.
Bye.